Hello.
Should on?
Good afternoon. Let's get started. Our speaker next week will be Zin Smati, who is the president and CEO of GDF Suez North America. It's a very large company. GDF Suez has operations all across the world. It's about a $150 billion company, and Zin is the CEO of the North America operations. He'll talk to us about energy transition, especially what the electric utility industry is going through. It's a very special occasion, so please join us for that talk next week. It's a real special pleasure to introduce to you our speaker today, Jonathan Silver. Jonathan is one of the country's leading thinkers on clean energy, an advisor to many companies, and really a leader in this space. And you will get to hear from him many of the things that he has done, but he has really been a part of the changing face of clean energy in the US and also globally. He is the managing partner of Tax Equity Advisors, a fund focused on providing financing to mid to large-scale solar projects, and CEO of Greenbanc Global, an advisor to both clean energy companies and investors. During the first Obama administration, Jonathan led the federal government's $50 billion Clean Energy Investment Fund, leading investments in a range of very large projects, including in geothermal, in nuclear, in wind, in solar, just name it. And sure Jonathan will give you some more examples there. Not surprisingly, he has been named by many different venues as one of the country's top 10 influencers in green technology. Among his many distinctions, and one of the ones that really amazes me, that he has served as a senior policy advisor to 4 US cabinet secretaries, including Energy, Commerce, Interior, and Treasury. And he has served and continues to serve on the board of numerous corporate and nonprofit organizations. He's a graduate of Harvard University, and it's a real pleasure to have you here, Jonathan, with us. Thank you.
Thank you. Thanks. Well, thank you very much. I don't have any fancy slides, and I don't do any of that stuff. So you don't have to do this, but it would be great if some of you in the way back moved up so we could have more of a conversation. You don't have to if you don't want to. I don't want to put you on the spot. I'm not going to call on you. He may grade you. I'm not going to. But thank you. I'm not sure when you come from Washington, D.C., as I do, being named an influencer is a great thing. But I've been involved in the clean energy business for quite a while. I was asked to talk a little bit today about financing the clean economy, which I'm going to do. But please, if anybody has any questions in the middle, interrupt, ask. We can go in any direction anybody wants. And I'm only going to try to launch some thought ideas out for 20 minutes or so, and then maybe we can roundtable it a little bit. I'm going to start. I want to make 3 points today. And they're probably not the points you're accustomed to hearing as I looked at the lectures and lecture series so far. The first point I'm going to make in talking about financing the clean economy is that the clean economy is already here. And in fact, all we're really arguing about, even in Washington, although they don't really understand that that's all they're arguing about, is the speed of implementation. And I'll even go further and say, who would really care about the speed of implementation except for the fact that the outcomes are binary and one of them is catastrophic? Other than that, we're along for the ride. The second may be equally surprising or sanguine, and that is we actually already have all the financing tools we need to turn this revolution into a reality. There isn't anything that we need to invent, and not much we need to do new to get there. And maybe the third point, which is a corollary or the yin and yang or the synthesis that brings it all together, is let's make sure in doing this that we don't fight yesterday's battles, we fight tomorrow's battles. I'm going to talk a little bit about where we are with the ITC, the PTC, what that really means or doesn't mean, and where we go from there. So let me start with the fact that I think the clean economy is already here. Wind, solar, geothermal, and hydro together in terms of power generation. Anybody have any idea how much that produces? We've only just started putting rooftop solar on. What do you think? 2%, 5%? Less than 1%. So wind, solar, geothermal, hydro account for less than 1% of total power generation in the United States. Anybody have another guess? 7. Anybody else? 12? Hydro's included. 13%. Now, how about nuclear? 19, right. Right. There are 101 active nuclear power plants in the United States. They account for about 19% of our power production. So together, what do you got? You got almost a third of power generation in the United States coming from clean and renewable sources today. Now, that wasn't true 10 years ago. We've made a lot of progress. That's the progress. We're on sort of what I would describe as an ineluctable path. We're inevitably going to get there. Anybody have any idea what, in fact, before I start asking questions, I should probably level set so I know who I'm talking to. How many of you are undergraduates? Wow, okay. How many of you are graduates? How many of you are graduate students in something related to clean energy? Okay. Those of you who are undergraduates, how many of you have ever taken a course in anything that relates to power generation, clean energy, or finance? Graduate students, how many of you have taken a course in finance? Excellent. Okay, great. And if I say anything or use any acronyms or something that you don't understand, just stop me. So, cost of a solar panel has dropped by how much in the last 8 years? 70. What? 80%. 106. 82%. The cost of solar panels has dropped 82% in the last 7 years. There are two parts to the price of putting a solar module, solar panel on your roof, right? I'm not talking about that. One is the cost of panels and everything that goes into them, and the other is called BOS, or balance of systems costs, right? That's how you actually install it. We have a long way to go in dropping those costs, but if there's one thing that we're really good at in this country, it's driving cost out of installation and infrastructure stuff. So it is reasonable to assume that we will continue down a very steeply declining cost curve in the solar industry. At some point, not too far from now, the levelized cost of energy, LCOE, anybody know what that means? Everybody? Nobody? Yes? No? Yeah? Okay, good. The levelized cost of energy will undoubtedly be less being produced by solar than by a fossil fuel for a very simple reason. What is that? That the input costs in solar are zero. The input costs in an extractive industry are not zero. So those lines cross. In fact, today, an onshore, plain vanilla, medium-sized wind farm is at price parity without subsidies to the generation of fossil fuels. So I think, in general, we are on a path that suggests that if we aren't there already, we eventually will be. The clean economy is, however, and I promise I'm going to get to financing, but I want to set a stage here. Clean economy is more than clean power and power generation, which is, of course, a subset of the clean economy. So here's some other anecdotal, slightly irrelevant examples of the clean economy. You can't buy a hamburger today from McDonald's that doesn't come in a biodegradable box. 28,000 people signed up and paid Elon Musk some amount of money to get the Tesla X. Those are market signals. Those really have nothing to do with, people screaming at each other. And by the way, for mere mortals who can't afford the Tesla X, the U.S. hybrid market is doubling every 3 to 4 years. In the same vein, we have 53 million smart meters that have already been deployed. I spent some time yesterday with a company that, not immediately here, but in Texas, is working on some very cool advanced software technology for buildings to continue to manage energy efficiently. Any of you know what the RE100 group is? Does that mean anything? It's a large group. It's a group of large corporations that have signed on to an admittedly voluntary, but nonetheless verbal commitment to move to 100% renewable energy as their energy source, and it includes such companies as Walmart, Procter & Gamble, J&J, Starbucks, Nike, Salesforce, Goldman Sachs, IKEA, Swiss Re, Nestle's, Philips, et cetera, et cetera. They aren't there yet, but they've signed on. So my general argument here is that we're on our way to a clean economy. In fact, I tend to think of it in three phases, and when I get to phase three, maybe you'll see a little bit clearer what I mean. Phase one to me in this space was sort of Rachel Carson, Silent Spring, Crunchy Granola, Birkenstock, Save the World. And I'm not being facetious, actually. It was appropriate to its time and place. I know you know who Rachel Carson is, right? Good. Okay. You need to know who Rachel Carson is. Phase two, Al Gore and moral outrage. There's a problem. You've got to start screaming about it. Appropriate to its time and place. But you can't actually win this war, if you perceive it that way, on the back of outrage. It's not sufficiently sustainable, and it doesn't drive economics. You got to get to what I call phase three, which is the creation of climate change millionaires. And I gave a talk someplace a few months ago, and somebody asked me what I thought the most important thing that had happened in this sector was the year before. And I'm sure they expected me to say something about EPA regs or Supreme Court decisions, but I think that in 2014, the single most important thing that happened was that Google spent $3 billion to acquire Nest. And all over the country, people went, whoa, what was that? When you get the market connected to a concept, a policy concept, it becomes very, very powerful. It's not just about company decision-making on the cost side. According to the Bureau of Labor Statistics, the 2013 Bureau of Labor Statistics, I love this part, there were 3.4 million green jobs in the United States in 2011. That's a lot. There were 84,000 direct jobs in mining that year. Now, why am I quoting a statistic from 2011? Because in 2013, when the Bureau of Labor Statistics issued that report, Congress, in its infinite wisdom, cut off funding for BLS to continue to track job development and job creation in green industries. Which is a little puzzling because, or maybe ironic would be a better word, because BLS does track jobs in the oil, gas, and coal industry, which those industries, of course, use constantly as the rationale for why they should receive additional subsidies. The markets are working. Take a guess at how many millions of dollars was invested worldwide in clean-related investments last year. Anybody? 10 million, 100 million, billion? Global, what do you think? Global worldwide investment in clean sector. What? 10 billion. 35 billion. That's a big number. Anybody else? 20? You're all close. 310 billion. $310 billion was invested in the clean sector last year. 51 billion of that directly in the United States. That somewhat understates what happens in the United States because a lot of U.S. companies are building things outside the United States. But in any event, the point is 5 times what was invested in this sector, directly in this sector, in the United States 10 years before. For those of you who are curious, the largest areas of investment in the United States last year, Asset finance for utility scale solar and wind, $18 billion. Funding and financing for rooftop solar, $13 billion. Public market equity raises for EVs and Yieldcos, $10.5 billion. VCs, $3 billion, which isn't that bad a number, actually. I say that as a former VC. So part one, my point is the clean economy is already here. It's not fully developed. It has a long way to go, but it's not gloom and doom. You got to look at this as a movie, not as a snapshot, right? We are on a very long, very significant growth curve in this sector, which is going to last for a very long time. Point two, we already have most of the tools we need to do this. I will tell you a funny, horrible story, or a horrible, funny story, depending on your point of view. When I ran this loan program, this $50 billion government investment fund, I was asked to go up on Capitol Hill one day and do something which I think makes a great deal of sense. The Democrats, in this case, I'm sure the Republicans do the same thing, House members, once a month hold a brown bag lunch in which, with no staff, no press, nobody, and they invite whoever they want to, generally one person, to come and talk about a topic. They asked me to come up one day and talk about clean energy finance, which I was happy to do. I think it made all the sense in the world. So I started launching into project finance, special purpose vehicles, bankruptcy remote stuff, tax equity, blah, blah, blah. And in about 5 minutes, everybody was on their BlackBerries because they still use government-issued BlackBerries. And I realized I had made a mistake. I was ahead of my skis. So I said, let me back up because I just want to be helpful. And let me go way, way back. There really are basically two kinds of capital, two buckets you can pull from: equity and debt. And an elected official, elected member whose name some of you might know, leaned across the table, there were about 30 people around the table, pointed his finger in my chest and he said, "Debt, that's what the banks do." And I thought, wow. He was not happy about that fact. I thought, I can't get from there to nuances about project finance in the 30 minutes left to get through my bag of chips. So we talked a little bit about equity and debt, and I went on my merry way. But the point is, we have all the tools we need. We know what the financing mechanisms are. Our elected officials don't always know at federal, state, and local levels, and that's part of the issue. But that doesn't really have anything to do with the existence of the financial tools themselves. There are lots of sources of capital for this stuff. VCs, private equity, sovereigns, hedge funds, debt providers, banks, tax equity, green bonds, Yieldcos, government grants. I'm going to go through each one of those now sort of quickly. I apologize to those of you who do know some of this stuff. This is going to be a little superficial because I think there are a lot of people in here who may not know this, but just to try to level set. But ask anything at any level and detail, I'm happy to go into it. So the kind of financing you use, not surprisingly, depends on what you're trying to do, right? And it depends on the capital intensity of the projects, the tenor or term, the length of the projects, the cash flows around the projects, et cetera, et cetera. But there are tools available for each kind of thing. However, let me go through the first one, venture capital. I did see a snippet of an earlier presentation when somebody went through venture capital in some detail, so I'm certainly not going to do that here, but I am going to point out four things, two of which were made in the presentation, but the other two weren't. The first is that with respect to clean power in particular, venture capital is not really a good fit, right? Because it's capital intensive. It takes huge amounts of capital to get this stuff off the ground. The second is that it's largely illiquid. The third is that it has bounded returns, right? Because power generation projects are really only in certain markets allowed to charge a certain amount, and in certain markets able to charge a certain amount. And the fourth is that it's a heavily regulated industry. So all four of those things, I was a VC for 8 or 9 years, I promise you all four of those things are anathema to venture capitalists, right? None of those things are good, and even one of those things is a deal killer. So two things. One, That's one of the reasons you don't see a lot of venture capital in this sector, particularly in power generation now. And the other reason is because, unfortunately, the way that venture capitalists learn that lesson is by making those mistakes up front. So they put lots of money into power generation deals, then they realized they were all going kaflooey and they lost all their money, and that's not a good thing for a VC either. Here's a little sidebar. I mentioned this to somebody the other day, and so I'll tell you it here too. If anybody in here wants to be an entrepreneur, I'm going to give you a life lesson right this second. Write this down. The single most important question an entrepreneur can ask a VC is what? Anybody? How much money you have? What do you know? Who do you know? What's the single most important question an entrepreneur can ask a VC? I'm way off financing here. When he's going to get his money back? That's a legitimate question, but I don't think it's the most important. What's the?
How much equity is my company?
That's certainly one that comes up in the negotiations. Absolutely right. The single most important. That's fabulous. You must have been an entrepreneur. The single most important question an entrepreneur can ask a VC is, what year are you in your fund? Because venture funds work this way. They basically have 5-year investment periods, 5-year harvest periods, and maybe 1 or 2 single-year add-ons at the will of the LPs, of the investors, who always grant it. So at the outside, you got a 10-year window, and you really have a 5-year investment window. So if I am a VC and you are an entrepreneur, and I am in year 4 of my fund, I'm starting to think about exits. I'm already pushing you in a direction. What if I'm in year 4 of my fund and my fund stinks, right? I've really got to have you as a winner. This is going to sound odd, but the same problem exists on the other side. What if I'm in year 4, 5, 6 of my fund, and my fund's great? I can go out and raise another fund, and you're still in the portfolio. Who cares, right? So I used to say, to try to be as transparent as possible to entrepreneurs, that the only point at which their interests and mine were completely aligned was the day we wired the money. From that moment on, we were trying to help them grow and get out, and they were trying to grow. And at some point, those two things differ so significantly that there are inevitably discussions that need to be had. In any event, VC works in this sector, but it doesn't work in power generation, right? Because it really is just preferred equity, and preferred equity with a timeline, which means that by definition it's driven to asset-light businesses, right? That's why there's so much money that's gone into social apps and other kinds of things. It's 3 people and a dog when it gets started, right? And you can see whether or not it works, and you can continue to fund it. But if you try to set up a silicon wafer manufacturing company, you need $200 million. And if you're a VC and you have a $200 million fund and you've put $10 million into this and reserved 10, if this doesn't happen in 2 years, which it won't, what happens? You start to get diluted, right? And eventually the thing's a giant hit. If it is, mostly it's not. And if it is, your equity stake has gone down to here. So financing, using venture as a kind of financing is relevant and appropriate in the clean space, but mostly in energy efficiency, sustainability kinds of things, services companies, although VCs have problems with services companies and the like. Private equity. Private equity and big buyout shops, the Apollos, Ares, TPGs, Canyons, fill in the blank, are getting heavily into clean. I'm going to start saying clean economy because it's broader than just clean energy. Getting into clean economy in a big way, and they're really doing it in 3 ways. Equity, what are called warehousing facilities, and project debt. If you don't know how, maybe I should spend a minute on this. Here's how a clean power project gets put together in the most simplistic fashion. A developer says, I want to build a wind farm, or I want to build a solar plant someplace. And he or she goes out and begins to aggregate land. Then they got to go get permitting for the land. Then they got to go get environmental reviews and approvals and other kinds of things. And then they're ready to build, except these things are expensive. So developers don't have enough equity to run these things. Over here, banks are prepared to provide construct debt, principally for construction debt, because they're just building things that, I mean, the technology behind building a wind farm is not complex. Some of the technology inside the nacelle, which is the motor of a wind turbine, is complex. But the rest of it is sticking a tube in the ground. Pour cement, stick a tube in the ground, raise some turbine, some blades, and stick them on. But it's really, really, really expensive. So the bank won't provide the capital until there's more equity essentially buffering it. So where does the developer get the capital? Nowhere. Who's going to put up capital for a known 8, 10, 12, 15% return, maybe in the mid-high teens if it's back leveraged? Nobody. Because it's equity. You can't afford to get an 8% return on equity. So the government, in its infinite wisdom, saying, we want these projects built. And by the way, when I say these projects, I don't mean only clean and renewables. We use what I'm about to talk about, tax equity, for all kinds of things. Fossil projects, roads, bridges, tunnels, anything that is considered an infrastructure project that meets certain IRS regs qualifies for tax equity. What is tax equity? Tax equity is just the name that has come to be attached to the equity that comes from some other place into these projects that probably wouldn't have gone there except for the fact that the government has provided tax incentives for it to do so. So tax equity is really a shorthand way of talking about tax-advantaged equity. And the return profile is actually pretty attractive. The return profile is you get a bunch of tax credits, you get something called makers, which is a fancy way of talking about accelerated depreciation, and you get all of that up front. So if you make a tax equity investment in a solar project, you get 80% of your money back in the first year in the form of these tax credits and accelerated depreciation. That's a tremendous IRR, and then there are other cash features associated with a project like that, so that your net after-tax return over the life of the investment is sort of 8 to 10%. That's great, because you say, well, wait, that's equity, why is that 8 to 10%? But it's not real equity, because the government said the only capital you can use to do this come from funds you've already set aside to pay taxes. Now it's a hugely attractive opportunity because I'm turning a cash tax liability into an income-producing investment. Wow, I'm in. Count me in. Historically, tax equity has come from banks and insurance companies for the obvious reason that what they are interested in are known cash flows over a period of time, because they have to match outflows they know they have for other requirements to wherever they're going to get that money from. What we're working on in one of our little businesses, Tax Equity Advisors, is introducing this notion to large corporations who have huge cash tax bills and for whom this is a perfect product. The interesting part is you go talk to the CFOs and even the directors of tax of these big companies, and by and large, they don't know anything about tax equity. If they know something about tax equity, they don't know about energy. If they know anything about energy, they don't know anything about clean energy. And if they know anything about clean energy, they hate it. Yeah.
What is that fund you set aside to pay taxes? So that's
It's not a fund.
income?
So you have $10 billion of revenue, and you're going to pay $2 billion of tax. You have to pay $2 billion of tax. It's your tax bill. The government says you can take a portion of that money and use it in this fashion. And it's an interesting conversation, sidebar, with CFOs, because while you see them grapple with it, because, well, if I was going to take some money out, I'd go build more stores, or I'd start a new line of business. You're not allowed to do that. You already have to pay the tax, all right? So you get one option. use some of the tax money for this or send it to the government. Those are your choices.
That means you don't have to pay the tax.
Right. You get back from credit. So the other thing private equity is doing now is, and you probably, if you're following this industry at all, they're providing warehousing facilities. There's a huge amount of work going on right now in solar financing. The unbelievably fast summary version of that is people first put it on their houses themselves. That wasn't going to go anywhere, and it certainly wasn't going to go anywhere, at scale. So people said, well, we can do this by leasing it to you. We'll own the stuff and put it on the roof. It won't cost you anything, and you'll save money, and we'll get the tax credits and everything else. And that worked well for a while until people said, wait a minute, how come you get all the benefits? So the industry evolved the solar loan solar loan financing, which says we'll lend you the money and you pay us back, but you get the tax credits. And that exploded. And now we're in a situation where the expiration of the ITC, does everybody know what ITC stands for? Investment tax credit? Okay. So the investment tax credit is, although it's used all the time to talk about solar, has nothing to do with solar per se. The investment tax credit is available to anybody for anything and has been around for 30 years and provides this 10% tax advantage break that I was referring to. The solar piece of it for residential provides a boost from 10% to 30% until the end of 2016, when it sunsets, unless it's continued. There's a lot of debate about that in Washington, and it's part of something called a tax extenders package that may or may not be continued or not. But in any event, the moral of the story is at the end of 2016, that bump, that incentive from 30 drops to 0 on residential, although it only goes back to 10 on commercial. And that is very dangerous for the solar loan industry, because the loan industry is premised on that incentive. So we'll have to see where that goes. Hedge funds. The only thing I'm going to say about in trying to give you this broad sweep of how financing works in this space in a short period of time, not so easy. All I'm going to say about hedge funds is this. I was a partner in a big hedge fund for a long time called Tiger Management, and so the volatility that you actually see in the marketplace and you hear about on news reports, and oh my God, SunEdison is crashing and this is going down and everything. Ironically, the folks who care least about that are the hedge fund guys, because they thrive on volatility, right? That's where they make their beta. So everybody knows what beta is? Okay, it's the, what's that? I'm sorry, alpha. What did I say? Beta? It's the alpha. It's the risk. It's basically what the profit from the risk profile. In any event, the moral of the story is that the hedge funds have been in and out of this space, and because they are coming in and out of this space quickly, they are exacerbating the volatility around these companies. Commercial banks principally provide construction loans, tax equity. We talked about green bonds. Green bonds are a new feature. Newish feature of the last 4 or 5 years, mostly produced by municipalities to generate revenues of one kind or another. I think that's a curious thing that we've done, because we've sort of harmed ourselves here. If you can rate a financial product, if you can securitize it, if you can slice it and dice it and put it out in the market, it's not a green bond, it's just a bond. We've caught ourselves up in the vocabulary of green, to a certain extent, to our disadvantage. And as part of my argument for tonight, as this industry matures and as we begin to really focus on finance and financing and financial returns rather than leading with climate change and green and marketing, we will open up these opportunities. Yieldcos. Have you heard of Yieldcos? Yes? No? Okay. A Yieldco is essentially the way an owner-operator of a power asset can monetize or recapture the embedded economics of that facility. And by essentially, again, grotesquely oversimplifying, essentially by saying the future cash flows from that asset are worth 100. And if you give me 90 today, you get them, right? That's really all it is. The problem with Yieldcos, and the reason that they're having so much trouble right now, is the right structure for a Yieldco is a closed-end product, where you take operating assets, and by operating assets, all I really mean are power plants of various kinds, right? You drop them in, and that's it. And you say, that's what's in there. The cash flows are worth this, discounted back to here, plus your discount, and then you've got a steady state revenue stream. Instead, what happened is people threw assets into this new structure because you could monetize it, which is just a fancy way of saying you could get somebody else, in this case the public markets, to pay for it, all right? But you promised them yield, right? You promised them essentially growth. There's no growth from fixed assets with known payout streams for a defined period of time. So what do you have to do? You got to go find more, and you got to dump them in there. But there are a fixed number of those, finite number of those, not a fixed number, finite number of those, which means people are now competing to buy those assets to drop them into their Yieldcos. And that ruins all the economics for a Yieldco owner. That's part one. Part two is these really only work if you own a bunch of assets. So utilities it makes great sense for utilities to do Yieldcos, although many of them haven't gotten around to it yet. It doesn't really make much sense for a financial entity to put a Yieldco together because their cost of capital is higher than the utilities, right? And so at some point, and we've discovered that we're already at that point, at some point they can't compete. And since, go back to what I said before, they've promised yield and therefore they've promised growth, that's the death spiral. And that's, for example, if you're following this industry at all, that's a little bit of what's happened to SunEdison, not completely, but that's a little bit of what's happened to SunEdison in the last few months.
Same thing with energy Yieldco?
Well, NRG has a bunch of other problems, but yeah, basically. NRG, you all know well, this is Texas. You know what NRG is, right? NRG has spun off, not yet officially spun off, has aggregated its green divisions into a GreenCo, into a new company, because they've been losing a lot of money. It's been very damaging for the stock, et cetera, and they've said they're going to put another $125 million up, but it's really not real cash. It's really a revolver, and at some point that'll be spun off as well, and NRG will be left with fossil assets. If you don't care about climate change, and in finance we're not talking about that, if you don't care about climate change, that's a perfectly acceptable portfolio of assets, except that it has a declining life cycle.
So what happens to Yieldcos when the Fed finally eventually starts raising interest rates? Because they're not only the problem of chasing more assets to do a drop down, I guess that's
Yeah,
the term,
right.
but also they work better in an ultra low interest rate environment where people are chasing yield.
Yes,
So that's accurate?
that's an accurate statement.
Are there other particular issues?
Those are the two big ones. If you're not familiar with what we're chatting about here briefly, so this works particularly well in essentially an ultra-low interest rate environment, which is where we've been for the last few years, because you're paying interest. Any interest you pay is better than no interest if you're an investor. But if the interest rates start to rise and you have actually fixed contracts around this, you've got a problem, right? You've got an even bigger problem because a lot of these don't have fixed interest rates, and so they have interest rate volatility in an environment in which interest rates are rising, which is really never where you want to be. I want to try to get through the rest of this really quick so I can open to questions. So anyhow, the last part, I'll just talk about other sources of capital, of course, government programs and support. That ranges across a continuum from bleeding edge startup supports. ARPA, you don't know ARPA-E? Everybody know what ARPA-E is? Great. So ARPA-E is an example of how the federal government was working to provide capital to these great new technologies. The guy who started ARPA-E, who's a wonderful guy, Arun Majumdar, who's now a professor, back being a professor at Berkeley, and was a colleague of mine, I was very jealous of, because although he had 235 million and I had 50 billion, he got to start every speech by saying 99% of everything we invest in will fail. But something's going to change the world. If I had gotten up writing loans and said 99% of everything we do will fail, I would have been decapitated, which I almost was anyhow. So you have ARPA-E kinds of things. You have targeted grants. You have the loan program. The fund that I ran was called the Loan Program Office. It's really a large pool of capital created by the Stimulus Act to not actually to invest in clean energy per se, but actually to create jobs. Okay. Here's another insight. It is really tough to do something well when you're mushing together two completely unrelated ideas, like advancing clean power and job creation. For example, after you've built that wind farm someplace, how many people do you need to run it? Like 10 guys in a wrench, right? There's no, you're headed in the wrong direction if you're trying to emphasize job creation. But I will say, how many of you were here to hear Martin Kenney? Everybody? A few of you? Nobody? Okay, I won't spend a lot of time on it, because he actually talked a little bit about the loan program, but there were some things in there he said that I thought weren't quite accurate. And I was going to try to address them here, but if most of you did not hear those remarks, I won't go into it. Suffice it to say that a loan guarantee program, which can be done at a federal level, a state level, a local level, it can be done by a sovereign wealth fund, anything else, is essentially a backstopping tool, right? What a loan guarantee is really a guarantee to a debt provider that if there is a problem, the guarantor will step in front of the provider of the debt. And it encourages the debt provider to provide debt. Why would you need to do that? Because the debt provider is providing debt to build innovative technologies, and debt providers hate technology risk. The challenge in the loan program and in others, the way that Congress designed this particular one, is there's a real important distinction between a loan guarantee and a loan, right? It is true that every deal, everything we did was a loan guarantee, but if you're providing support to the sponsor, equity of the sponsor, as opposed to the debt provider, the loan guarantee the Department of Energy is writing is a guarantee to the Department of Treasury, which is giving a loan. It is technically a loan guarantee, but to any reasonable person on the planet, it looks like a loan. And that caused some of the debate as well. Let me move quickly to point 3, and then I will wrap up and we take all kinds of questions, which is tackling the next set of challenges. My argument essentially being that we shouldn't fight yesterday's wars. Yesterday's wars here, to me, are the endless discussion around the desperate need for the ITC, the investment tax credit, and the PTC, the production tax credit, which is essentially the equivalent used for the wind industry. And that's what every lobbyist in Washington is focused on. And there is some reason to care about that. The whole industry is built on that. But the economics of this, the cost of this industry is dropping so dramatically that that issue, in my opinion, is becoming somewhat less important. And you run the risk, if you focus exclusively on that, of missing the next set of issues which are actually more important. And let me give you an example of 3 or 4 that are. The economics of this industry will change dramatically when the Office of Management and Budget uses something called the social cost of carbon in its calculations of budgetary impact. I don't have time today to talk about what the social cost of carbon is or how it's calculated, but basically suffice it to say that it begins to introduce the notion that there is a cost embedded in the carbon footprint of something that we need to calculate. If any of you have ever done any business cost accounting work, and you've looked at attributable costs and allocable costs, and the attributable costs are the direct costs, and the allocable costs are what portion of the air conditioning for the whole university are we using here, and how much of that should be ascribed over here, and there are people who are good enough to come in and clean in here this evening. How much of their time should be allocated to this stuff? It's the allocation methodology. And changing that number by a tiny amount has huge impacts on budget decision making. I'll give you another example totally unrelated to that. At some point soon, I hope, but at some point, some Wall Street analyst is finally going to write the real report, and there have been nibbles at it around, that's going to say, those fossil fuel companies that have these huge balance sheets and count all the stuff that's in the ground as assets? Well, it's never coming out of the ground. And therefore, it's a liability because you got to maintain the property as well. When an analyst says that, and then 2 and then 3 start to say that, the market caps of these companies are going to begin to quiver and shift, and you're going to see massive capital flows, not necessarily into renewables, but just out of them. Right? And that also is going to change the economics of the business. Here's a really important one. The rating agencies, Standard & Poor's, Moody's, etc., still aren't really comfortable with rating project finance efforts, which is how you build big clean energy projects. What does that mean? Who cares? Why should we care about that? Well, because lots of investors, like mutual funds and others, aren't permitted to invest in a product that isn't rated by an agency. So the more ratings we have in the marketplace for securitized product, everybody know what securitization is? Yes? No? Yes? You bundle a bunch of stuff together and you slice it up into little pieces, and you can slice it by risk or by tenor or by anything you want, and you securitize it, meaning you package it and you sell it out, and people can buy securities in that package. They can buy little pieces, little slivers of that package. You can't securitize basically anything with widespread distribution unless you have a rating for it. So some of you may have seen that Solar City has done a few privately rated securitizations. They've bundled together rooftops and sold them into the marketplace. But Solar City is this big, and the 1 or 2 that they've done have been about $50 million each, and they cherry-picked what went in there, which is not bad. That's the thing you would do, right? To begin to seed the market, to begin to show the market how you can securitize this product. But if we can get the rating agencies, which is a new battle, not an old battle, that'll change financing a lot. Then there are a couple of other things that are going to have big effects. For those of you who are following the solar industry, you are hearing, you are learning, you're seeing that actually rooftop solar is probably not the solution. It's a part of the solution, right? Why? Because a bunch of people can't use it. Their roofs are too slanted, there's too much shade, they don't own the house, they live in multi-unit dwellings, the landlord won't do it, blah, 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 blah. So the future there is around something called community solar. And financing, community solar is really nothing more than a small utility size plant put somewhere not on your roof that you can then sell people into. Think of it as timeshares, if you will, or if you're the developer, you might think of it as a strip shopping mall where you're filling, tenants into your facility. But that changes the economics, and there's a very different kind of financing there because rooftop financing is done by solar rooftop financiers and or installers and or. But community solar will be financed at least in part by the utilities. And the utilities have these huge AAA rated balance sheets, and that drives down the cost of that rollout very significantly. And I'll end maybe with this as the battle of the future, since I just mentioned utilities. I think as a result of all of this, you're going to see a tremendous change in the utility industry. And not incremental change, massive change, but not anytime soon. I believe that 20 years from now, the utility industry, the utility in the United States will actually be an insurance company. It will play the role of an insurance company. And you as a consumer will no longer see your monthly utility bill as a utility bill. You will see it as a monthly insurance premium. And what the utilities will actually be providing you is peaker power. That is to say, you will be essentially off the grid. There will be so many people off the grid that it will be the grid. And utilities will guarantee you that if something goes wrong in your little microgrid, they'll flip their peaker switch and off you go. And you will be charged through the nose for peaker, but that's what you want because everything else is so much less. And it's a very, if that happens, which I think it will, then the economics and financing of this industry are completely different, and will never look like they do now. The biggest change, of course, will be that the economics around the way utilities build things, which is very complicated, it has to do with public utilities commissions and rate bases and other kinds of things, will change because they won't be building anything. What they really will be is distribution and billing arms around their insurance product. They'll essentially be a warranty for your microgrid. So a super fast run through how different kinds of things get financed. I'm sorry we couldn't dig down into any of it, but I hope it was helpful. So there you go. We have
Sure. So you said the rating companies do not feel comfortable rating these type of projects. I didn't get why. I mean, to me, it's really probably the return of investment is probably low, but it's a very stable or
well, no.
low.
The reason ratings agencies have been so slow to move on this is that there's no historical data, right? They don't have it. No one actually knows how long solar panels will really, really work. They're guaranteed for 15 or 20 or 25 years, and the offtake agreements last that long. But what if they don't? I mean, nobody really knows because we haven't had solar panels up in any kind of breadth of scale for that period of time. They are rating wind projects now because wind's been around for 30 years. I mean, so the real question is historical data, and the question is how fast can we get rating agencies comfortable with data they haven't historically had. That's why there are little companies like Kilowatt Analytics that started up and others that are gathering this data that frankly the rating agencies should be gathering for themselves and packaging it in ways that make it digestible for them. Oh, sorry.
So you mentioned how maybe some Wall Street analysts are going to come out and say that like fossil fuel assets are soon going to turn into liabilities on the balance sheet. In your opinion, do you think that if the companies are going to forecast, are they forecasting these capital outflows? And if they are, what are they doing to try to hedge against that risk? Or are they just buying time and waiting for their assets to turn into liabilities and then they'll just run with it?
Well, I think the fossil companies would argue that what I've said is not the case. In fact, this stuff will come out of the ground. But let's just use a couple of random data points. So last month, the federal government, the Department of Energy, returned $2 billion to the U.S. Treasury for monies that had been appropriated for carbon capture and sequestration, saying they couldn't use it. There were no projects out there that were sufficiently robust or far along that could demonstrate with some degree of certainty that this would work. When was the last time you saw a federal agency return money to the federal government? I think when you say that, you pretty much said, we don't have it yet. It's not happening anytime soon. So that's sort of observation number one. Observation number two is they will also tell you, as Rex Tillerson, who's the CEO of Exxon, said to me once at a dinner several years ago, we're big in this stuff. We've committed $600 million just to algae research. over a 10-year period. I said, that's fantastic. That's $60 million a year, which is like, what, 4 seconds of your operating budget? And then he didn't talk to me for the rest of the dinner. I don't know. So I think that they are wrestling, with what to do. Here's another problem that they have, unrelated to their own dynamics. We focus on the cost of a barrel of oil here, which currently is, $40, $50, $60, way down, by the way, of course, from 100 plus. Saudi Arabia, what do you think the internal price of a barrel of oil? A barrel of oil they produce that they use themselves, what do they charge themselves for it? $9 a barrel. It was 7 last year. $9 a barrel. So think about the transfer pricing here. The reason Saudi Arabia and other Middle Eastern countries are so eager to move into renewables, including solar, is A, they got a lot of sun, and B, they can take their $9 barrel of oil and sell it to us for $50. That's way better. And so that causes a different economic decision-making process for U.S. Fossil fuel companies as well. But you just saw some drilling up in the Arctic. Didn't pan out after a lot of time and money went into that. I mean, eventually these companies are going to move away. Now what they're going to do is they're not going to invent this stuff. They're going to buy it. And that actually I probably should also have mentioned, which is, although it's not financing per se, it's financing in a macro sense. I think we are also entering a huge wave of consolidation over the next couple of years. I don't know if any of you were at, for example, Solar Power International, the big solar industry conference in Anaheim a few weeks ago, but if you walked the floor there, I'm making this number up, you would have seen 50 racking companies. You know what a racking company is? Yeah? No? Yes? Yeah? Right. There's no room for 50 racking companies. There's room for 5 racking companies. Right? It's like any other industry. There's going to be Hertz and Avis, and down here there's, whatever. There's Enterprise and National, and then down here there's a bunch of others. But there's not 50 of them. And by the way, what do racking companies do? They bend metal. That's all they do. Every industry in the world needs bent metal. And there's so much bending of metal going on that we have a very good understanding of what the operating margins need to be. And the operating margins for racking companies in the solar industry do not look like that, and they will inevitably converge, right, on the mean of where bending metal companies are, and that's going to squeeze a bunch of these guys out. And by the way, that's a healthy thing, right? Because then you have your 5 platform companies in the space, and they grow big, and that's terrific. I promise you that you will open the newspaper as this wave of consolidation begins over the next 18, 24 months, and you will read wildly inaccurate assessments of why that is happening. Okay? It's happening because the ITC is going away. It's happening because everybody rushed into Yieldcos. It's happening because the industry is, this is my thesis. It is happening because the industry is now sufficiently mature that that's where we are in the industry growth cycle. We're in the first wave of consolidation. You look at any traditional industry in the United States, and it's rapid growth, consolidation, and up the curve, right? I mean, there's nothing new here. And that's where we are now with this. Yeah. Oh, I'm sorry. I guess he's in charge. I'm not.
Yeah, so I just had a question of going back to what you said about insurance companies acting as a utility, or utility companies acting as insurance companies in the next 20 years. So
Yeah.
Did you mean that, like, in the next 20 years, like, my house would have, like, solar panels, and if anything went wrong with them, like, the utility company would have, like, backup power for me?
That's exactly what I meant.
Okay, yeah, that's all I meant. Thank you.
We have time for only 2 more questions. One here and then
Thank you. So in the last question, you talked about how big companies will buy technology from somebody. And we talked a lot about today how we're going to roll out existing technology, and we have financing mechanisms to roll out existing technology. But my question is, so where are we going to go finance new technology if not VCs? So it seems like there's a big hole in the middle to this narrative.
Well, the hole that you're referring to is that classic, crossing the chasm hole, but The answer is we're going to finance certain things certain ways and other things other ways. We are not going to finance power generation with venture capital money. Sure. We're going to finance power generation with balance sheet money, and we're not even going to finance power generation in the classic sense of the word, because increasingly we're going to distribute the generation. There's a huge role for venture capital, but it's in asset-light related kinds of products.
But I guess so the thing I've been thinking about is if, say, unlike software, we have to talk about material sciences or, making huge, algae farms or trying to figure out that technology. Who's funding sort of that intermediate scale?
So that's actually a really good question, and the answer is, in my opinion, the way it's always been done, which is actually through corporates. And where we've gotten off track a little bit has nothing to do with clean energy and the clean economy. It's kind of the whole way we think about financing around venture capital. My view is that most innovation is actually incrementalist in nature, and it's really intended as problem solving. A company says, we need to cut the cost of that 20%, or we'd like to turn it this way, or we wish it could be this big, or something. Those are incrementalist improvements financed historically by the companies. And materials science is actually a particularly tricky question to deal with, because it's a thing, right? It has to go somewhere, and therefore the technology only improves if you buy the incrementalist argument to the extent it is layered onto, attached to a thing already being done. So the real question might be, and I don't want to put words in your mouth, but is how do you get to breakthrough technologies in an area like materials science? And that's where I think government monies, particularly grants, come into play. Historically, we didn't do giant scale-up stuff like I was doing in government. Historically, we went to pilot projects and demonstration projects, and years went by. And frankly, my view is that if we can free ourselves from the reality of, but the artificial political urgency of the noise around got to do it tomorrow, in fact, we will continue to finance important materials science efforts in exactly the same way we always have.
Take one question, Dave,
Oh, shoot. Okay, thank
Sounds like
you.
he has your number.
Well, thanks for your time, and insights are excellent. It's interesting to think about the utility model being perhaps an insurance company, but another model might be, and just want to get your comments about utility basically being an outsourced battery co. For evening. Just want to get comments there. I'm going to sneak it in. What about comments on grid storage and utility scale solar?
That's a whole class in and of itself. But I'll take all of those, and if you don't mind, I'll twist it a little bit around the issue of storage sort of writ large. Storage is like the big hot new thing, except it's not hot and it's not new. It's especially not hot. And it's not new. We've been working on battery technology since the beginning of time. The reason it's important is that battery storage, if it works, and it increasingly does, allows you to time shift, right? So the sun rises at 8 in the morning and it sets at 6 in the evening, and that's all you got, and therefore solar isn't base load. Everybody know what base load means? Okay, solar isn't base load. But if you can store some of that power, and we're working with things like molten salt technologies now, and aluminum shavings and other things which absorb the heat and then release it in a slow but known rate, we can extend the amount of time we've used the non-baseload technology. So that's observation number one, is that's why people care about storage, and particularly about storage with respect to solar, to a certain extent wind as well, because they turn intermediate power generation into baseload generation. The second notion is you can put storage by your own facility, right? So Tesla has invented the home battery, which is really a giant piece of plastic that holds lots and lots of tiny little batteries that are in your computer. And but it's a really important thing, because you then become the utility, right? you store power, which, by the way, comes from your Tesla, or anything else that's generating power, including the solar panels on your roof, and stores it for you, and you are your own mini utility as long as that lasts, which, by the way, to the extent all of you had one of those battery packs in your home, would speed up the transition of the utility industry to being an insurance company, right? Because you'd essentially be going off the grid, and the way you have to start thinking about off the grid is on the grid, right? And then maybe the last part of the storage piece is commercial, and there's companies like Bloom Energy, if you've ever heard of that, or those look like giant railroad card containers, and what they contain is ways to store power. And some companies use ice. I mean, you open it up and there's ice in there, right? Because ice actually stores heat as well, and then as it melts and it cools, and it's how they regulate HVAC power, principally in the off-shift hours, in the late evening hours, et cetera. But storage is a really big deal, and it's going to be increasingly important. You're going to continue to read a lot about it for a long time to come.
Thank you so much, John.
Yeah.
Thank you for the talk.
Hope I didn't bore you.
No, it's thrilling. I love geeking out.